Mr. Ashok. Unit 1, 2 and 3. Unit 1 is self-occupied property, so it will be nil, no tax is chargeable. But he will claim deduction under section 24 for interest paid. Unit 2 is used for business and profession. So all calculations relating to Unit 2 will be considered in profit and loss account of business or income and expenditure account of profession. So no calculation under house property. So we will have to divide all municipal taxes, interest for 3 units. Is that so? Unit 3 is let out. It is actually earning the rent, third property. Unit 3. So it is taxable. Okay. So format we will use regular format, step 1, step 2, step 3. Okay. Before that, we will discuss about pre-construction period, which is very important working note for all of you. See, define pre-construction period. What is pre-construction period? It is the period starting on the date of loan and ending on immediately preceding 31st March before the date of completion of construction, DOC. Hence, in the given question, pre-construction period is date of loan, which is 1st April 2018 to immediately preceding 31st March 2020, because your completion is April 2020. So before that 31st March is here. So total period of 2 years means 24 months. Clear? We will calculate the interest. That amount of loan is 5 lakhs. Rate of interest is given to you 12%. 5 lakh into 12% is equal to 60,000. If 60,000 is for 1 year, for 2 years it will be 1,20,000. But friends, the treatment for deduction under section 24 for pre-construction period interest is here. 1,20,000 PCP interest is deductible in 5 equal annual installments. Clear? We are calculating assessment year 21-22. So 1,20,000 total PCP interest into 1 by 5 or divided by 5. So per year 24,000. So in consecutive 5 years you have to show the deduction. 24, 24, 24 up to 2025, 26. This is the treatment given in section 24. So for present case, we have to take only 24,000, this only. Rest of the part will go to next return of incomes of Mr. Ashok. Okay? Now 1st April 20 to 31st March 21, this is our current year. For current year, 5 lakhs into 12%. So current year interest is how much? 60,000 plus 24,000 from pre-construction period. So total interest comes 84,000. Now 84,000 interest is for full house. Okay, entire house 84,000 interest. We will divide by 3 units. So per unit 28,000 interest is deductible. You have to show these separate calculations. Working note should form part of your answer. It is going to give you exact marks. So presentation must be like this. Okay, we will come to the format. Thank you. We have calculated working note number 1, in which we have defined pre-construction period interest. We calculated pre-construction period interest. Okay, we divided it into 5 installments. We got 24,000. We added current year interest 60,000. Total 84,000. Per unit 28,000 interest we have calculated. Now we will solve the problem. This is our format. Step 1, municipal valuation, which is not given, or fair rent. Fair rent of each unit is given 60,000. So we will take 60,000. Whichever is higher, automatically higher is 60,000, because point 1 is not applicable. Okay. Higher of step 1 is 60,000 or standard rate not applicable. So naturally I will take lower of step 2 is 60,000 or actual rent received from unit 3, it is given to you 72,000. Clear? So 72,000, whichever is higher, higher is 72,000, less loss due to vacancy. There is no vacancy loss given. So I'll take it nil. So final gross annual value, GAV, gross annual value is 72,000. Same I'll take it here, 72,000 gross annual value minus municipal taxes. Now municipal taxes are given total 18,000. Okay, due are 18,000. Into bracket it is specifically given, out of which rupees 15,000 are paid by the SSC. I told you section 24 deductions, other deductions also. Municipal taxes are deductible if that taxes are actually paid by the SSC from pocket. In the given case 15,000 are paid, no doubt. But 15,000 for full house, you have to take only unit 3. We are calculating unit 3. So did I write here? So for 15,000 for full house divided by 3, for 1 unit it is 5,000. Is that clear? I have written here 15,000 divided by 3. So after deducting taxes, municipal taxes, net annual value is 67,000. As per format, 2 deductions are there. Section 24 deductions. A is what? Standard deduction, 30% of net annual value. Now no net annual value, net annual value is 67,000. So 30% of 67,000 is 20,100. Point number B, interest on loan. I have written working note number 1. Already we have done it in first working note. So it is 28,000. So after deducting these 2 figures, final income from unit 3 is 18,900. This is for unit 3. For unit 2, I told you that it will be calculated. All incomes and expenses relating to unit 2 will be considered in a separate head of income, business and profession. We are calculating house property. So we will calculate only unit 3 and unit 1. Okay. Come to unit 1. Unit 1 incomes. It is self-occupied property. It is not let out. When property is self-occupied, then gross annual value is nil. And it is specifically given to you that Mr. Ashok has not opted for new tax regime under section 115 BAC. So we will calculate as per normal procedure. Gross annual value is nil. So no tax will be deducted even if it is paid. For self-occupied property, no municipal taxes deduction will be given. Net annual value is nil. Clear? Section 24 deductions we will deduct. A is 30% of net annual value. 0 into 30%, 0, nil. In B, interest on loan, working note number 1, 28,000. So loss from unit 1 is shown as it is a deduction. Now what we will do? In last statement we will prepare a statement, computation of total income in the hands of Mr. Ashok. We will add all incomes. Unit 1 is loss, 28,000, plus income from unit 3, it is 18,900. So minus is more. Minus 28,000 plus 18,900. Final answer is loss from income from house property. 9,100 in the hands of Mr. Ashok. Is that clear? So I hope it is understood. If any questions are there, we can ask. That's all.